Welcome to the Real Estate Espresso Podcast, your morning shot of what's new in the world of real estate investing. I'm your host, Victor Minash. When you listen to J Powell speak from the podium at the Federal Open Market Committee meetings, he typically talks about managing the Fed's dual mandate to maintain price stability and to maximize employment. Price stability is code for managing inflation. The past several years have been focused on taming inflation, and the core personal consumption expenditures inflation rate measured 0.3% for the past 2 months, meaning June and July. We'll get the August report on September 26th. On an annualized basis, the Core PCE inflation rate remains pretty sticky at 2.9%. This is higher than the Fed's 2% target. It's not zero, and it's not runaway inflation either. I don't want to get into the debate about whether the measurement is appropriate or not. That's maybe discussion for another day. So we'll take it for now that Core PCE is what the Fed needs to set interest rates. The other side of the coin is the labor market. Now, if you've been listening to this show for a while, you know that I've been flagging the inconsistencies between the two surveys that make up the employment report each month. There's the payroll survey and the household survey. The numbers reported in the two surveys are not consistent with one another, and they've not been consistent for a long time. The employment report, what's often called the headline report, is the one that most likely is being overstated. Well, yesterday, the Bureau of Labor and Statistics announced a significant downward revision to the employment data for the U.S. Here are some of the details of that major revision. The U.S. economy created 911,000 fewer jobs in the year ending March 25th than initially reported. This is one of the largest, if not the largest, preliminary downward revision on record. The revision suggests that the average monthly job gains during this period was just over 70,000 jobs, a significant drop from the original estimate of 147,000 a month. The major revisions were concentrated in several sectors. Number one was leisure and hospitality, with 176,000 fewer jobs than previously estimated. Then professional and business services were down 158,000 jobs. Retail trade was down 126,200 jobs. And then government jobs were also adjusted down by 31,000. So the causes for the revision are, quote-unquote, a normal, regular part of the process. These monthly job reports are based on surveys of a sample size. It's about 120,000 businesses, and the annual benchmark revision incorporates more complete and accurate data from state unemployment insurance tax records. Nearly all employers are required to file these reports. The large size of this particular revision is attributed to factors like a slowdown in business growth, changes in immigration levels, and a decline in the response rate to the BLS surveys. The revision provides a clearer, although less optimistic picture of the U.S. labor market over the last year. It confirms the downward economic cycle in fact started earlier, and it was more severe than previously understood. That news has added to concerns about the health of the economy, especially following recent weak monthly jobs reports. The revised data could influence policy decisions. A number of economists are suggesting that this will push the Federal Reserve to consider cutting interest rates at their meeting next week. Now, it's important to note this, too, is a preliminary revision. The final and more definitive numbers will be released in February of 2026. Now, at this time last year, there was another preliminary revision reported in August of last year, and the BLS estimated that the U.S. in fact had created 818,000 fewer jobs than previously estimated for the year ended March of 2024. These are not small revisions. We also know the president publicly fired the head of the BLS. Now, when revisions are happening with such shocking regularity, it's no wonder the data can't be relied upon. And yet, this is the very data that's being used to set monetary policy, which directly affects the cost of capital for real estate investors. These are a big deal. This is not something to just gloss over. And there's a lot of concern that now with the firing of the head of the BLS that agency might become politicized. That is a real risk. I absolutely get it. But equally, I think the process for collecting and reporting employment data can be improved. And it's not good enough to say that quality data takes a year to collect. So with this latest employment data, it's almost a foregone conclusion, in my opinion, that the Fed will cut their benchmark lending rate at next week's meeting. The real question is how much, whether this will affect the medium-term bond yield and in particular the 10-year bond yield. The bond yield is a reflection of risk for those bonds that have a risk premium attached to them. But I don't believe the U.S. Treasury market is in fact carrying a risk premium. Countries like Ecuador, Argentina, Brazil, they carry a risk premium. I believe the yield on the U.S. Treasury is a reflection of the economy. Weaker economic cycles will pull down the bond yields as growth is going to take a hit. A stronger economy will bring inflationary pressure on prices, which will tend to drive yields up. Now we have a 30-day T-bill trading at 4.17%. That's very close to the Fed funds rate. We've got the 10-year Treasury trading at 4.08 and the 2-year Treasury at 3.55 and the 5-year Treasury at 3.61. So almost a 50 basis point spread between the short-term rate, the medium-term rate, and then back up to the 10-year. This is the market clearly signaling that over the medium term, interest rates are heading lower. That is good news for real estate investors. As you think about that, have an awesome rest of your day. Go make some great things happen, and we'll talk to you again tomorrow.